Time for a special segment, Quarter Se Quarter Tak. Nigel has walked over to the big wall and we are telling you what to expect from the cement space today. Nigel, morning.
Well, morning. Let's get straight to the point then. The quarter is expected to shape up as a strong one for the cement industry. It's going to be aided by a low base, improved pricing discipline, even as volumes remain a little bit tepid. Let's break it down across pricing, volumes and profitability. Now, after 5 straight quarters of year-on-year decline, cement prices have grown in Q1FY26. Remember, this comes post a marginal 2% increase on a quarter-to-quarter basis that we saw in Q4. And now in this year, in this quarter, we expect to see another 3% increase in pricing. The South, that will lead the way with hikes of around 10%, which will be supported by production discipline, while the East as well saw some kind of traction as recent price hikes were largely accepted by the market out there. But pricing in other regions, you talk about North India, West, it remained more or less range-bound. Now, reports suggest that companies are attempting another hike in July. That's basically to offset the typical monsoon-led pricing weakness that we see. Cement demand, well, growth is expected only around 3 to 4%, primarily impacted by the early onset of monsoons, the sluggish construction activity, particularly in North India, and the India-Pakistan skirmish also weighed on demand in various parts of the border regions. Meanwhile, the central region, well, it held up relatively better. With regard to volumes, UltraTech and Ambuja, well, they'll outshine. But that's because, they have inorganic growth that will be getting factored in as well. So that's why both those two will deliver double-digit growth on volumes. JK Cement volumes, well, that will grow, led by traction in central India. On the other hand, Shree Cement, Dalmia Bharat, Ramco Cement, they're expected to see a flattish to a negative growth number. Now, despite soft volumes, margins will improve, with the average EBITDA per tonne estimated at around 1,070, which will be higher by around 40 rupees quarter-on-quarter, and will be higher than more than 200 rupees on a year-on-year basis. Companies with higher exposure to South India, well, they'll see an EBITDA expansion of around 250 to 500 rupees, while those in North India, as well as Central and West, may see a flattish to marginally lower margins as well. Remember, the aggregate cost per tonne is expected to increase by around 2% sequentially, but that's because of operating leverage, negative operating leverage that will play out. Petcoke price volatility as well as stable coal prices may lead to a bit of an uptick in energy cost. Shree Cement, well, that will be delivering industry-leading EBITDA per tonne, though on a sequential basis, it'll be a little bit lower. So we're working with a number of around 1,350 rupees. While UltraTech, Ambuja and JK Cement, well, they will gain owing to the operating leverage. South-based players like Dalmia Bharat, they'll benefit from the price-led margin expansion. Well, let's sum things up. Q1FY26 could be a price-led margin expansion story with demand yet to fully fire due to seasonal and other regional disruptions. The sector appears, though, well-positioned for a better showing in the second half of the year, assuming some of these price hikes do hold out. Well, let's wind this down then with a valuation snapshot that comes up for you on the screen. Let's get in our analyst that we have on the show, Rajesh, Ravi, institutional research analyst who joins in. Hi, Rajesh. Thanks a lot for joining in. What are you working with on that EBITDA per tonne basis? What is the total increase and which company will outperform on that parameter?
Hi, good morning, Nigel and others. As you rightly pointed out, this quarter, the realization for cement companies have improved sequentially. Second quarter in a row when prices have improved, thereby leading to a YY recovery in cement prices. Most of the price increase has happened in South and East market, which where prices had fallen to decadal lows. So these two markets, EBITDA margins should improve the best sequential basis. On on an aggregate basis, we are factoring in 90 rupees EBITDA per tonne for the sector as a whole, out of which the South and East-based players should report 200 to 300 rupees EBITDA per tonne improvement, Q on Q.
Got it. All right. Rajesh, what about price increases? Finally, we're seeing after many quarters, at least on a year-on-year basis, prices are higher. Q2 will be a little bit softish, but that's seasonal in nature. For the year on the whole, what kind of a price increase are you working with for the sector? And if you could also tell us what kind of demand growth you're looking at, because it'll be low single digits that we'll work with for Q1.
So see, for this prices have improved for sure, and this was much needed. The South and East market prices had come down to insane levels. mostly because of volume push by cement majors. Now, because everyone is in a bad shape, the profitability had gone in a bad shape for most of the players. Rationality has prevailed or seemingly prevailed, and that is why we are looking at healthy pricing. And we believe that part of the price hikes which have come through should sustain through. However, on a full year basis, we expect that the Q1 pricing should be close to a peak number. We will not be seeing the full year similar margins. So for full year, we are factoring in around 170, 180 rupees EBITDA per ton improvement on an aggregate basis. That would still make it the aggregate closer to 1,000 rupee versus 820 odd in FY25. And I believe that is much needed.
Got it. All right, Rajesh, there's this buzz of consolidation in the industry. Let us evaluate this one asset, Deccan Cement. The stock has run up 50% in 1 month. So the street is sniffing something. We have seen this in the past, but what's happened in the last 12 to 18 months, some of these deals have actually taken place. So let's just get a fair value for that asset. It appears that the debt in the books is around 600-700 crores. Market cap's around 1,500 crores. So we are around 2,200, 2,300 crores of EV. But also there will be some capex that will have to be incurred to get the company from a 1.8 million ton to 4 million ton.
Yes.
What kind of assumption can we make on that additional capex? And what is the value you would give it on an EV per ton basis at current reckoning?
So you rightly said this, incremental capex which would be required, which are understanding, from their annual reports and credit rating reports. Another 300 to 400 crore for sure would be due to complete the 2.2 million ton expansions, which has been significantly delayed due to cash crunch. So that makes the EV closer to 2,600 crore on the current spiked up prices. So that already takes the stock to $75 per ton. Given a south-based asset, it will be more of an acquisition of an asset rather you're acquiring any brand, or any other strategic fit. So anyone who would going to acquire this company may not be willing to pay more than $80-85 per ton for sure. Even if you look at the recent acquisitions which have happened in barring India Cements, if you look at all the assets in South and all, they would have happened below $90, so closer to $90, and they're much bigger assets with much bigger infrastructure, even beyond cement, ancillary infrastructure. So from that perspective, Deccan Cement is fully pricing in an acquisition price, which if it happens, we don't see much upside from here. But again, that's quite a guess, if it is going through.
Rajesh, we'll leave it there. Thank you very much for joining us. Quick but punchy chat on cement expectations.